Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm very good, Bryce. Very excited for this episode. We have one of our favorite expert investors all the way from the US back on to help us make sense of what's going on in markets.
Yes, very much looking forward to this episode. I think it is the third time that our guest is joining us on the show. And I know our community are also very much looking forward to this one as we've reached out to them to get some questions from them that we can ask as we go through this interview. So we are hoping to do that. Our guest started his career at Bear Stearns, went on to found a multi-billion-dollar hedge fund and now publishes the Felder report. I guess it is our pleasure to introduce Jesse Felder to the show. Thanks for joining us, Jesse.
Hey, thanks for having me, guys. I can't believe it's 3 times already. Wow.
Yeah. Well, we have been kicking now for about 4 years, so I guess we're not recycling guests, but getting some of our favorite back on the show, as we were just discussing offline. I think we really enjoy listening to your podcast and also reading the Felder report. And we wanted just to check in with you at a time like this to really understand from your perspective what is going on. So as I mentioned in the intro as well, we've got some questions from our community that we'll also be asking as we go.
Terrific. Yeah, let's do it.
So I guess, Jesse, if we start in a general sense, the last few months have obviously been very turbulent and very outside the norm. And, you know, we're all recording from our respective houses at the moment. So if we start broad, how would you summarize the last couple of months, both in the broader economy and in financial markets?
Well, it's been, a fascinating time, really. I was writing back in January and February. It was really especially interesting to see a lot of the indicators I look at throwing up red flags. Obviously, these weren't related to an oncoming pandemic, but they were related to the economy and the stock market. You had a big Dow theory divergence where the Dow Jones Industrial Average was making new highs and the transportation average, made its high back in 2018. And so that's usually a kind of an economic red flag that was cropping up. At the same time, you had a lot of those cyclically sensitive sectors in the stock market just really performing poorly, like transportation and retail, metals and mining. These are all kind of red flags that you would look for just beneath the surface. We also had another cluster of Hindenburg omens in February. I think there were 7 of them on the New York Stock Exchange in a period of like 10 days. So that's just another sign that breadth was really, really poor in the stock market, and earnings growth was, flattening out. And so there were a bunch of kind of red flags, as I mentioned. And at the same time, it was just absolutely fascinating to see stocks like Virgin Galactic, Tesla going totally parabolic, and investors diving into the options market like they've never done before. So the amount of call buying, investors buying call options to open, was something, it was like 50% more than anything we've ever seen before. So there was this kind of speculative, euphoric blow off in January and February. And meanwhile, the economy was kind of, like I said, throwing up red flags. And so it was this huge dichotomy that you rarely see, where you have this surging euphoria in terms of sentiment, kind of not supported by fundamentals at all. And then at the same time, this pandemic, you could read about it in China and spreading outside of China and around the world, and still the stock market didn't care. And so it was fascinating to see all that. And then all of a sudden, the pandemic caught up with the stock market, and we had this crash, 30% plus in the S&P 500, the fastest 30% plus decline from an all-time high that we've ever had. So that was, the market trying to reconcile it, pricing in a euphoric situation and then having to go to something totally different. And so I wouldn't say that it's something that, yes, it's been unprecedented, the speed of it and the depth of this decline from all-time highs, but we've seen things like this before. In the 1987 crash, the 1929 crash, the market has a history of rapidly reversing, especially when it gets pushed too high by speculative euphoria.
So you mentioned there that we had the fastest sort of bear market in history. And now we're seeing, some serious exuberance and a pretty quick recovery as well. How are you thinking about the speed of not only us going down, but now what's happening going up? I think we woke up this morning and saw that Amazon's now broken new record highs. How are you thinking about that?
Well, one of the dynamics that I think behind the crash is a lot of these highly leveraged systematic strategies that are kind of the tail wagging the dog now, the stock market dog. And a lot of it is related to volatility. So whether it's shorting volatility outright or volatility targeting strategies like risk parity or these types of things, when volatility is going down, they're leveraging up on the long side and buying. And through a virtuous circle, they push volatility down, which makes them buy more. And, that goes on until volatility reverses. And then they have to unwind all at once. When volatility is rising, they need to sell or cover their volatility shorts or whatever it is. And so I think the speed of this decline was partially a product of that, of volatility targeting strategies and short selling of volatility, having to unwind these massive short positions. And now that volatility is falling, we could see this working the opposite direction, that these strategies all literally got entirely out of the market. A handful of really good articles that kind of documented this, that all these strategies had either their zero net long exposure or had gone hugely net short the stock market as of 3 weeks ago. And so there really wasn't much left in that space to unwind and push stock prices lower. But now that they're all short or don't have long exposure, now that the VIX and volatility is falling, now they have to go back and put that exposure back on. And so I think that's what we're seeing, is these types of strategies exacerbating the short-term trends in either direction.
So Jesse, on that, in previous recessions, we've seen sort of initial falls and then retracements up and then further falls. Do you think we're seeing a similar thing with the recent rise here, or do you think it was a sort of V-shaped fall and recovery just because of the nature of some of the trading strategies that we're seeing in the pandemic and its recovery?
I have to be honest, I change my mind on this topic regularly. 2 or 3 weeks ago, I was very, very bullish. I took off all of my short positions, all of my hedges, and was, for the first time in a few years, was just long only. And I was very bullish because just some of the things that we had gotten so oversold, and the coil had wound so tightly in terms of that oversold, that it was pretty clear that a rebound was coming. But now that we've had close to 30%, I think, upside from the lows, it feels to me like we have to, at the very least, retest those lows. If not, I think it's very likely that we're going to break below those lows in a longer term bear market. I think to think that we're going to have a V-shaped bottom here in the midst of the worst economic crisis in anyone's lifetime is very, very optimistic.
Yeah, it seems optimistic, especially when you think about just how overvalued the market was before. I was reading somewhere that to get just back in line with the market's long-term median PE, I think off the US large caps, their median PE, the market had to fall about 50% from its February high. We saw it fall 30%, which was a massive fall, and everyone, it was, it hurt everyone and it was big news, but that didn't even get it in line with its median PE, let alone, below that. And when you think about it in those terms, it just feels like, we're still in such frothy territory here.
Oh yeah, I mean, what the Nasdaq 100 I think is flat for the year. I mean, it's right. It's right now the Nasdaq 100 is not even down for the year, and to think about that we are literally in the midst of the worst economic crisis in anyone's lifetime, probably. I think Ken Rogoff has said in at least 150 years, and the Nasdaq's not down at all this year. That is, as my friend Grant Williams would say, something that makes you go, it's really hard to reconcile. I think that this is going to be much, much longer, drawn out economic problem than most people, believe. Everybody wants to try and put a letter shape on it. But I think another friend of mine, Peter Atwater, has pointed out that when you go through a traumatic event like this, it takes a long time to come back from it. People don't just go immediately back to life, as it was. And so there's a lot of different ways that can play out. But you also mentioned PE ratios. The one thing I think people don't appreciate about PE ratios in the short run, yeah, you can look at, okay, we need to go down, I don't know, you maybe say 30, 40, 50% to get back to median PE ratios over any decent historical period of time. But what most people don't appreciate, I think, is that profit margins are also at their highest levels in history. So that E is also inflated. And so if profit margins revert to their historical means, which there's been a ton of great studies about this. I can't remember who put it out, but John Authors wrote an interesting piece in Bloomberg about after a pandemic, you usually see historically the main, I think, lesson you can kind of draw from a pandemic is that labor gains at the expense of capital after on the backside when you come into recovery. And that would be a complete reversal of what has inflated profit margins over the last 30 years. We've seen corporations take a bigger and bigger slice of that profit pie, and labor has taken a smaller and smaller share of it. So if that trend reverses, that means earnings are probably not going to come back to the peaks that we recently saw for a very long time. I mean, it could be a decade or two before earnings come back. So that's another important dynamic to think about.
Jesse, a lot of the chat in our community at the moment, we've got a lot of new investors on their journey just coming into the market at the moment. Some perhaps who may have bought their sort of first stocks in January and are now questioning the whole idea of investing, and others who are trying to figure out the construction of their portfolio. How would you think about, if you were sort of taking a longer term approach early in your investing journey, how would you think about positioning a portfolio at the moment? Would you be entering the market? What sort of things would you be looking to have in that portfolio?
Yeah, I mean, that is just a terrific question. I think first to folks who are learning some painful lessons during this, I can't remember, I think it was from one of the Market Wizards books. I can't remember who it was, but he talked about using losses or looking at losses as tuition in the school of trading or tuition in the school of investing. Everybody's going to have losses. If you read about any of the greatest investors of all time, Paul Tudor Jones, for example, I think went completely bust 3 times before he figured out what he was doing. And so I think for anybody to come in and think I'm just going to put money in the markets and have a wonderful experience without any losses is pretty Pollyanna-ish. But also I think you have to look at it like, as long as you learn something from your losses and vow to not make the same mistake twice, you're making progress. And so I think that's an important way to think about it. Tuition at the school of investing is what your losses are. But I also think it's a really, really exciting time to be looking into investing right now. For those that want to dig below the surface of the indexes, in the small cap value space, there are some incredible opportunities right now. Ben Graham has written, famously wrote about what the situations he looked for, which he would call net nets, which are stocks that were essentially trading at less than half of their liquidation value. And you can find those today in the markets, and especially in the small cap stuff that's outside of the major indexes. There are stocks that are trading at 25 cents on the dollar, 20 cents on the dollar, and that offers terrific risk reward. So for me, any type of long exposure I have right now is pretty heavily focused into small cap value. And then I think it's probably important to keep some dry powder, because there's a really good probability that we're going to make lower lows on the indexes at some point. We might test those lows weeks or months from now, but I think probably it'll be before the end of the year we'll be testing those lows, potentially making lower lows. And so you always want to have some type of dry powder. And the last thing you ever want to do is buy anything on margin. You want to make sure you're in a position to where you're going to be able to live to trade another day. And a lot of traders on margin will get completely wiped out. And that's the worst situation that you want to avoid completely. So I would say for people who aren't as adept at maybe doing that individual equity research, it's really important to be diversified outside the United States stock market, especially. U.S. is one of the most expensive stock markets in the world. Emerging markets offer much greater value, and then also have a significant allocation to non-financial assets or real assets, which would be real estate, precious metals, etc.
Yeah, Jesse, we'll get into your thoughts on some of the non-equity asset classes in a minute, because we find your writing and your thinking on it very interesting and definitely worth exploring. I've got one last question on equities before we do. And this is similarly from our community. In the last bull market, everyone seemed to be very much into index investing in ETFs. And that was no different in our community. They were very popular. Now, as the market falls, there's a lot of conversation around active management. And in Australia, we have listed investment companies, which I guess the analogy would be mutual funds in the US. How do you think about splitting your portfolio between passive long-term index investing and more active management to take advantage of the opportunities that this downturn presents us?
There's a really good case to be made for passive investing, diversifying to prevent you from making mistakes in terms of putting too many eggs in one basket, picking the wrong stocks, all that stuff. Index funds allow you to diversify dramatically and really reduce that risk. Also, lowering cost is extremely important. So being able to lowering cost to just several basis points on some of these ETFs is a huge boon to investors, especially over the long run. I mean, if you can just save that, 1% a year, it adds up to a huge degree. My biggest problem with index funds are the way they're constructed. I think most people don't understand that they're not only market cap weighted, but they're float adjusted market cap weighted, which is, to me, there are two problems. And the market cap weighting is its own problem in that the more popular a stock gets, the more overvalued a stock gets, the more you're going to buy it, the bigger an allocation it becomes in your portfolio, which is kind of the exact opposite of what somebody like Warren Buffett is trying to do, and focusing more on the more undervalued securities in the markets, or at least not overpaying for securities. And I think the index, by its very nature, forces you to overpay for securities, and then those undervalued securities in the market, you're systematically underweighting. And so it's designed, I guess, to be more of a momentum strategy just through that market cap weighting. But also the fact that it's, to me, is float adjusted market cap weighting. Go back and look at a stock like Intel and look at the performance of Intel when Andy Grove was running the company. Andy Grove owned 30% or more of the shares outstanding. And from the mid-'80s to 2000, he was running the company, and Intel was one of the best performing stocks you could ever want to own. During that period, the index systematically underweighted Intel by the amount Andy Grove owned. And so you would have a 30% less weighting in Intel because of the insider ownership. And then when Andy Grove retired from the company, sold all his stock in 2000, the index said, terrific, now we're going to boost our position in Intel. We're going to own a bunch more of it now that Andy Grove has sold all of his stock. And look at Intel since 2000. The performance, it's gone nowhere. It's literally made investors no money. So the index systematically underweights owner-operated companies and systematically overweights manager-operated companies. And that's the exact opposite of what I try and do as an investor too. So I think the simplest way to fix these two problems is by just using a different type of index. And Rob Arnott is a guy I had on my podcast a couple of months ago, Research Affiliates. He developed about 15 years ago what he calls the fundamental indexes. And it's just same companies. We're not going to weight them by float-adjusted market cap. We're going to weight them by sales, book value. We're going to weight them by their fundamentals. And that really prevents you from putting too much money into stocks that are overvalued and not enough money into stocks that are undervalued. And that same thing with putting too much money in manager-operated companies, not enough in owner-operated companies. It fixes all of these problems and still allows you to be passive and get a low cost. So I love the fundamental indexes.
Yeah, nice one. I imagine a lot of our audience right now are pulling out their phones and playing fundamental index. Jesse, we want to move to the government response and central banks' response to what's happened in markets. Because as Bryce and I get deeper and deeper into financial Twitter, we start to sort of read more and more worrying things about the consequences of what some of this central bank activity can lead to. You've written and thought about what massive rounds of QE are going to do to, the US dollar, to bond markets, to gold and other real assets. If we once again start broad, can you sort of summarize what we've seen the Fed and other reserve banks do and how you think about that action and some of the consequences that we might sort of see as a result?
Sure. I mean, it's a huge subject with a lot of different moving parts, but I'll try and simplify it as much as I can. For the past, 20 or 30 years, the Fed has acted as, they've acted as the buyer of last resort, I guess, is the way you could look at it in the markets and trying to prop up the markets. After the crash of '87, Greenspan came in and cut interest rates to try and prop up the market. He did again after long-term capital management in 1998 and 99. We saw the NASDAQ go up 100% in 1 year. A lot of that was inspired by extreme monetary policy. After the dot-com bust in the early 2000s, they dropped rates to 1%, which created the housing bubble. And after the financial crisis, we dropped interest rates to zero for most of the last decade. And then the Fed started buying up treasury bonds to try and lower interest rates, not just at the front end of the curve, overnight money, but start lowering interest rates on 10-year treasury notes, 30-year treasury bonds, these types of things to make mortgages lower, and auto loans and all these types of things have lower interest rates. But also they did it to try and push investors I'm going to buy up your treasury bonds. And so now you're going to have cash in your account and cash yield zero. So what are you going to do with that money? And the Fed consciously did this to push people into corporate bonds and into equities kind of out the risk spectrum to try and push the prices of financial assets higher to promote a wealth effect. And this didn't create inflation in the economy, but it created inflation in financial assets, in stocks and bonds, and in real estate too, because a lot of those things are just based on the cost of capital. When your cost of capital is zero or close to it, you can pay a very high price for these things. And the reason this didn't result in inflation in the economy is because it kind of was just relegated to the financial system. But there's a point at which the fiscal authorities, and I'm talking about the federal government, was relatively subdued during this whole time. But when the federal government starts getting into the act and starts spending money hand over fist, there comes a time where the Fed is forced to not pursue their own monetary agenda anymore, but they're forced to support the fiscal agenda. And that point in time is where you transition from a kind of a disinflationary and non-inflationary monetary policy to very inflationary monetary policy. And I think that's what we're seeing right now. We already have $1 trillion annual deficits, and we're going to push $3 trillion plus this year. And part of what the Fed had to start doing in the repo markets late last year was step into the treasury markets and start buying these things, because I just don't think there were enough buyers out there in the market. And there's certainly not enough buyers for $4 trillion of new treasury issuance this year. And so a lot of what the Fed is being forced to do is to monetize a lot of, all of this new debt. And, that puts the Fed in a very difficult position, that if inflation does start to pick up, they can't raise interest rates because there's too much debt. And it could create a debt spiral if they raise the cost of that debt too much. And they can't stop buying the bonds because that would push interest rates up too, potentially if there's not enough buyers. And so the Fed is potentially in a position where they're creating a situation where there's going to be inflation and they won't really have the tools to fight it. And so it's a very interesting point in time right now where I think we're transitioning from a disinflationary environment to an inflationary one. It's a very long-term dynamic. It's going to play out over years, not over weeks or months. But I think that's where we're at right now.
So, Jesse, if we do see this serious inflation that you're speaking of, as you mentioned at the start there's a lot of really complex parts going on and a lot to try and understand and unpack. But for the everyday sort of retail investor, what does it actually mean if we do start seeing, hyperinflation? And how do you think about positioning your portfolio to accommodate for that?
That's a good question. I don't even think we need to see hyperinflation. I think the markets for stocks and bonds at least are essentially pricing in 0 to 1 to 2% inflation for the foreseeable future, for the next 30 years plus. And so you don't need to see a lot more than 1 or 2% inflation to see the markets react. And if inflation goes 3, 4, 5%, we're going to see the markets react significantly. And this is not just my thinking. I think if you look at a lot of the writings of a lot of the smartest people in this business, they're all kind of pointing in the same direction. They're not necessarily forecasting an inflationary environment going forward, but they're saying I want my portfolio to be positioned such that if inflation does arise, it's not going to hurt me too badly. Ray Dalio has been writing about this. Chris Cole recently put out a paper a couple of months ago talking about this. And just a number of the people I respect the most in this business are looking at this risk and making sure they're at least protected against this. The way you do that is you think about what performs best in a disinflationary environment. That's financial assets, that's stocks and bonds. So, right, when inflation's going down, that means interest rates go down, that means bond prices go up. When interest rates also go down, that probably helps equity valuations. Even though it shouldn't, that does make investors, more willing to pay higher valuations, because if you can get, 2% on a treasury note, 10-year treasury note, well, 3 or 4% dividend looks pretty good relative to that. So I'll pay that higher price earnings ratio in order to get the dividend income. When you're in an inflationary environment, interest rates usually go up, which means bond prices go down and equity valuations also come down. Equities usually probably do a little bit better than bonds because a lot of companies do have some sort of pricing power, consumer goods and these types of things. If, you're Coke, you'll be able to raise the price of your Coca-Cola regularly, hopefully to keep up with inflation. And that's one way equities keep pace. But as I mentioned, part of this is also related to corporate profit margins, and labor share of income has been a huge disinflationary force over the last 30 years. If labor starts taking back some of that share of profits, that's part of that inflation dynamic is labor cost. And so if a lot of that inflation dynamic goes to labor cost, that's going to hurt all companies across the board in terms of their profit margins, and the margins are not going to be able to keep pace. Profits won't be able to keep pace with inflation. And so that type of environment is really not good for stocks or bonds. And so you really want something in the portfolio that can protect you against that type of scenario.
Now, Jesse, that leads us to an asset class that you've written a lot about and thought a lot about, and that is gold and precious metals. Gold is often talked about as a good hedge in an inflationary environment. How are you thinking about gold in your portfolio at a time like this?
I think gold is important to have probably in any time in your portfolio, just as a diversifier. I really believe in having a portfolio of uncorrelated assets. And as I mentioned, Chris Cole's paper does a great job of showing the value in allocating to things that are non-correlated. And that's also part of the problem with stocks and bonds is I think over the last 20 years or something, they've been non-correlated. But that's actually more of a rarity. Usually stocks and bonds have been more correlated than non-correlated. And in the inflationary environment, they become very correlated. And so, a lot of these strategies that think, I own stocks and bonds, I'm diversified. Well, you've been diversified if you're only looking at the past 20 years of history. If you look back before that, stocks and bonds traded together a lot of the time. And so bonds didn't really play that ballast role in the portfolio like a lot of people are maybe counting on them to do going forward, especially when you look at interest rates are at 1% now. How much the 10-year treasury note, I'm actually under 1. How much more of that ballast role can they play if the stock market sells off? Yeah, they could potentially go negative, but I think you'd have to be crazy to pay to buy a negative yielding treasury note today with the amount of money printing that's going on and the likelihood of inflation being greater than 2, 3, 4% over the next 10 years. So I think that, gold normally plays an important role. It's going to play an especially important role. I think I've written it several times over the last few years. Times in your portfolio or times in history to buy gold, and there's times to buy stocks, and they almost never overlap. Usually when it's a good time to buy stocks, it's not a good time to own gold, and vice versa. And right now is a really good time to own gold and probably not a great time to own stocks. And so I would say it's more important than ever probably to have significant allocation to gold.
Just a question on the practical side of it. Obviously, there's a number of ways you can buy gold. You can obviously buy the physical stuff. You can also buy it on exchanges. There's often a distinction talked about between gold-backed things that you can buy and then just paper gold, which sort of correlates to the price. If, everyday investors, retail investors are looking to get exposure to gold, do you have any thoughts on the best way to do that?
I've been recommending this vehicle for several years now, and for the last 5 years, this thing's traded at a 5, 6, 7% discount to the gold and silver they hold in storage. It used to be called the Central Fund of Canada. Here in the United States, the symbol CEF. It was bought by Sprott maybe a year or two ago, and it's now the Sprott Physical Gold and Silver Trust. But it's essentially a closed-end mutual fund that owns gold and silver in storage. And one of the nice things about it was that you could buy it at a discount. I think now it maybe trades at a less than a 1% discount. But for the last 5 years, to me, that was a terrific sentiment signal that I could literally go buy gold and silver at a 5% discount through this closed-end fund for the last several years. The nice thing since Sprott took it over is that if you own enough shares, they'll convert your shares into bullion for you. If you're worried about, owning paper gold or whatnot, you can go to Sprott and say, I want to convert my shares. And so there's really no risk to owning paper gold through this vehicle, as long as you own enough shares. And I forget what that cutoff is, but Central Fund of Canada or Sprott Physical Gold and Silver Trust. I'm sure there's others out there, but that's the one that I've used.
Jesse, some of the, I guess, more hysterical people on Fin Twitter are speaking about this potentially being the decline of the US remaining as the global reserve currency and then potential rise for Bitcoin. What are your thoughts on Bitcoin or any other crypto at a time like this?
With a lot of the crypto aficionados, I agree with the first half of the premise, but not the second half. Of the premise. I do think there's a serious risk that the dollar loses its position as reserve currency. I do think with the money printing that's going on right now and the Fed monetizing it, there's no way the dollar's not going to have another major bear market over the next several years. I think the dollar's definitely headed lower. And we've already heard rumblings from all around the world that, Europe, Russia, China, they're all kind of tired of this dollar-based system and looking for alternatives, especially because we here in the U.S. have used it unfairly in the last 10, 15 years or so in a variety of ways. And so I think we are headed for a change in terms of that, in terms of all those things. There's a lot of change coming, and I think that, and that's not, I don't think that's a hysterical prediction. It's a historical one that throughout history we've seen massive changes, very consistently every several decades. And I think we're headed for another one. Where I disagree with the crypto aficionados is I don't believe that cryptocurrencies are any form of a store of wealth at all. I just think that they don't serve that purpose. And that's my personal opinion. I think, if you're looking for that, if it ain't broke, don't fix it. Gold has been that for 5,000 years, and it's not going to change. And so I think trying to create a crypto version of gold is trying to fix something that's not broken.
So Jesse, just on the global reserve point and the US currency, it potentially could be one of the biggest fundamental shifts in our investing lifetime, or at least Bryce and mine's, which it hasn't been that long.
Been quite short.
Yeah. What do you think the effects of that are going to be? I guess in a narrow investing sense, but in a broader economic sense as well. What will the US losing its status as the global reserve currency mean for the US markets and for the world?
I think it'll be bad for investors in U.S. equities, but that's about it. You look at, we've gone through so many changes, right? The British Empire was the, global hegemon before the United States, and, things haven't turned out too badly for them over the past 100 years or so since the U.S. kind of rose up. And who knows who the next one will be? It could be China. It could be some type of a global currency that's created. We don't know, but I think it won't be bad in terms of the U.S. economy or residents or anything. I think the main thing that I worry about is, as you mentioned, the U.S. stock market is probably the most overvalued stock market in the world. We also have probably the most overvalued currency in the world. You combine those two things together, and it means that investors that are too focused in U.S. equities are taking a big risk, not just in the hypervaluation of the equity market, but in the overvaluation of the currency. And so if you are not heavily weighted enough outside the U.S., it could be a painful reckoning coming for both the stock market and the currency.
So Jesse, with everything that's going on at the moment and, looking outside of the US market, what's exciting you in terms of opportunities, be it in equities in another country or perhaps real assets elsewhere?
Well, I do think the guys at GMO, that's Grantham, Mayer, Van Otterloo, have been kind of banging the table on emerging market value for a while now. And it's about right now as cheap as ever gets. And so I think that's an interesting opportunity where investors should be focused. Again, that's the opposite of this other trade that I'm talking about. It's a cheap stock market and probably cheap currencies. So that's a good way to kind of diversify away from those US risks I was talking about. But I think that's also kind of not wholly within my circle of competence. Where I'm most excited is in, like I kind of hinted out earlier, is some of these small cap value stocks. I'm finding stocks that were trading just a few weeks ago at, like I said, 20 cents on the dollar of their liquidation value. REITs that were trading at 10 cents on the dollar in terms of their net asset value. Things that, they're the types of opportunities that only come around once every 10 years or something. And so for me, that's where I'm really excited to be finding those types of opportunities again. I'm also, to be quite honest, pretty excited to hedge that trade by shorting the large cap indexes. I think if we do get another leg down in the stock market, they're going to come for the favorites this time. We saw a lot of, like you mentioned, Amazon and Netflix are at new highs. These stocks have not been hit at all yet. And I think those stocks that have been the bull market favorites for the last 10, 11, years are going to be the ones I'd love to use to hedge general market risk against general market risk in the small cap value stuff that I'm buying.
Now, Jesse, you've mentioned a lot of famous investors or interesting financial thinkers that you've been reading, and they've had interesting thoughts about different asset classes or the market as a whole. For people who want to, read some of what you're reading, what's some good places to either see what you're reading or to see what these guys are writing themselves?
Well, to me, I think one of the most valuable things I've found in the past decade is the list of people that I follow on Twitter. I follow Chris Coles on Twitter now, Ray Dalio's on Twitter. I think there's 97 accounts that I follow on Twitter. It might make me sound like a social media addict, but I don't miss a single tweet that any one of those people tweet. I'm not on Instagram or Facebook or, any of these, TikTok or anything, but Twitter for me is extremely valuable. And those 97 people provide me with an extraordinary base of information that I just ingest on a daily basis. And so to me, that's been really valuable. And it's not just the stuff that they write, but it's the stuff that they find and that, that they share through that medium that is extremely valuable to me.
I think if there's one thing we've learned from isolation, it's to go long TikTok. So I'm surprised you're not on there, Jesse.
No, I'm not on there, but I've seen some of the videos that are put up, and they are absolutely hilarious. I've gotten a great kick out of a lot of them.
Now, Jesse, we normally wrap up our interviews with 3 questions that we ask all our guests, but we've asked those the last 2 previous times you've been on the show. So we thought we would do something a bit different. At the start of each year, Alec and I do an episode on bold predictions for 2020, where we try and throw a few things out there. And I guess some of the ones that we threw out are all going to be wrong given the circumstances we're in at the moment. But if you were to make a bold prediction as to how 2020 might end, what would that be?
Gosh, a bold prediction. So part of the reason why I was so bullish a few weeks ago is everybody was so negative. Twitter's also a terrific sentiment signal for me that when I just tweet a lot of articles. I don't even put my opinion on Twitter very much, but I just see people's reactions. And when people were kind of making fun of bearish stories on Twitter, it was kind of a pretty good signal that things were too euphoric. And then a few weeks ago, I was tweeting a lot of bullish information. I mean, in terms of the amount of insider buying I was seeing, I was just putting up, especially in a handful of these sectors, and people were saying, "Oh, these insiders are idiots," and like you could just tell the negativity was getting way too thick. And so I hesitate to say this just 2 or 3 weeks away from that negativity, but I do think, I don't know if it's even too bold of a prediction, but I think we're probably going to finish the year beneath those lows that we saw in mid to late March. I think we're going to break down below that before year end, embark on the next leg down in this bear market that started. So like I said, that's my current view. I don't know if that's a bold prediction, but that's where I'm leaning right now.
Bold enough.
I definitely think that's sufficiently bold given the sentiment that seems to be in the market and, coming from leaders thinking that the economy is going to open up again in the coming month. So it'll be interesting to watch, and we'll have to get you back on and review how the prediction went at the end of 2020, the start of 2021.
Yes.
Perfect. I'm not afraid of looking like an idiot at all.
Don't worry. Bryce and I have spent 3 years looking like idiots, and somehow we've made a podcast out of it.
Perfect.
So, Jesse, we just want to really thank you for taking the time to share some of your thoughts. We're constantly reminded when we speak to you and when we read your writing or see what you're tweeting that you have great insight and you're a really clear thinker about what's happening in the market. So we appreciate you taking the time to come and share some of it with us. If people want to follow you, they should definitely jump on your Twitter. Is there anything else, a website or anything that people can jump on if they want to read more about you?
On a weekly basis, I try and put out a blog post at thefelderreport.com. And I'm active daily on Twitter, just posting a lot of the best things that I'm reading. So you kind of asked, how can people keep up with that stuff? That's really what I use Twitter for, is to kind of just share all the interesting stuff that I'm reading. So that's just at Jesse Felder.
Perfect. Well, Jesse, thanks again for taking the time. We really appreciate it. And we look forward to getting you back on towards the end of the year to review your bold prediction.
All right. Thanks, guys. It was a lot of fun.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.